Hello and welcome to today's webinar discussion on small business lending. My name is Ryan Himmel and I am the founder and CEO of BIDaWIZ.com, a professional network for tax and accounting services and the co-host of this event with Fundation. So let's get started with an overview of today's agenda. On a high level, we'll discuss small business loans and how they can benefit you and your clients. Specifically, we will walk you through the small business lending market and take a look at Fundation to understand how they are fundamentally changing the way small businesses obtain financing. Lastly, we'll go through more specific details on how accountants and advisors can deliver loans that fit their clients' needs. We will provide some examples of how specific CPAs have benefited from partnering with Fundation. Finally, we'll entertain any questions that you may have on this topic. So, without further ado, let's get started with a bit of information about Doug Gordon and the company he built to help small businesses with their financing needs. Doug Gordon is the co-founder and executive vice president of Fundation Group LLC. Doug founded Fundation in a desire to address the void in the marketplace to fill a major product gap, a product with terms that are similar to a bank loan, 2, 3, and 4-year terms, but with the willingness to lend to a broader spectrum of customers. Specifically, Fundation provides a similar product to traditional bank lenders, but with a streamlined approach in terms of the length of the process and the requirements from customers. They've been successful in achieving this objective, as it was publicly announced that Fundation's first year was the strongest of any online lender in the small balance commercial lending market. Their business grew exponentially since it closed its joint venture with the private equity firm Garrison Investment Group in November 2013. Fundation's current growth trajectory puts it on track to reach their goal of originating more than $100 million in its second full year of operations. As such, Doug and Fundation have been recognized in many major publications such as the New York Times, Entrepreneur Magazine, the Wall Street Journal, Dow Jones, The Street, and many others. Doug regularly contributes to the small business community by attending and presenting at many small business, accounting, and financial executive conferences, such as today's webinar. So without further ado, let's turn it over to Doug to learn more about small business lending.
And thank you all for joining me today. So we're here today to learn how to become an expert in the small business commercial lending market, and as we define it, the small balance commercial loan market, which we at Fundation have been really paying attention to since the recession back in 2008, 2009, where the press, article after article about the difficulty it was for small businesses to access credit and how the banks were not really serving the need. What we learned very quickly was that the underwriting processes that a bank employs are very manually intensive and very cost inefficient. So what a lot of banks say to themselves are, if I'm going to focus my efforts on lending money, right, and I'm going to lend $100,000 at 6%, and it's going to cost me the same amount of money to underwrite a $5 million loan at 6%, where am I going to focus my efforts? So as you would imagine, most banks have turned their efforts towards much larger commercial loans in an effort to maximize the costs they're employing in their manually intensive processes. Another big issue in the market is the bank's tolerance for risk. The small balance commercial loan market is very risky and much riskier than a bank gets comfortable with. The default rates can get into the high single digits and sometimes the low teens. And when a bank's looking to keep their losses below 1%, it's a very difficult market to serve on their part, especially with the lack of information that's typically available on a small business. The issue that the banks face is the fact that's very related to the risk tolerance, is the fact that they're underwriting many loans based on likelihood of collection and therefore take collateral very seriously in their underwriting process to see if something were to go bad, how much would I be able to collect? And the issue is that we're in a service-based economy now. The lack of high-quality collateral that banks can secure themselves against. The example I always use is if I were to lend to a women's clothing store and I was secured by 100 dresses that cost $1,000 a piece and the loan were to go bad, how am I going to liquidate that? And the answer is you really can't in a cost-effective manner. So it's very difficult for the banks to get comfortable with that. And along those lines, the small business market in general is incredibly heterogeneous. It's a market where you're throwing a doctor, an auto repair shop, a women's clothing store, and a real estate agent into one bucket and calling them a small business and asking an underwriter to treat them all the same when they're going to underwrite a deal. So it's becoming very difficult for the banks, or it's always been very difficult for the banks to get comfortable with this market. And these structural challenges have led in the last 10 to 15 years a proliferation of non-bank lenders that are trying to meet the debt financing needs of the small balance commercial loan market through a variety of different ways. And these lenders come in a variety of different forms, and we'll get into that in a second, but they come in the form of short-term lenders and intermediate-term lenders like ourselves here at Fundation. So the reason that they're able to serve this market and we're able to serve this market is because we have a higher tolerance of taking credit risk compared to what the banks do, right? So we're understanding that we're going to take losses and we're not going to be secured by collateral, and we're going to price accordingly in order to make sure that we're okay. We're going to give bank quality rates to the highest quality customers, and we're going to be able to price a little bit higher for the businesses that pose a little bit more risk, but still deserving of access to credit. The biggest driver to this market success and Fundation's success is the fact that we employ technology to streamline the underwriting process, and thus taking many of the costs out of a manually intensive process. So we're able to collect thousands of data points in real time to come to automated decisions as to what a good business is and what not a good business is. So it's drastically improving the time it takes for us to come to a decision on a given loan. And additionally, we're using a variety of different alternative data sources that are available on the market today that allow us to get a better insight into the business owner and the business, more so than what a business plan or a tax return has been able to do in the past to get banks comfortable. So if you take a look at the way the market looks today, we call it looks like a barbell. On one hand, you have the banks who are only serving the super prime customers, the best customers in the market, and typically doing this through an SBA guarantee. And one of the misconceptions in the market is that the SBA is a lender, when in fact they're actually a guarantor, and it's still up to the bank to choose whether or not they do commercial lending. So if you're a high quality customer, you have a credit score in the 800s or above 700, and you are looking to get a bank loan, you may be able to get it if you're willing to go through the process, but if there's any hair on your business or there's been any problems that have occurred in the past, it's still a very difficult market to access. So what's happened originally when the problem was first identified by alternative lenders was they came out with these products that were very short-term and high APR in nature. Many of you are probably familiar with merchant cash advances or cash advance term loans, but these products are typically 3 to 18 months and have APRs ranging from 30 to sometimes upward of 100% plus. They're been used primarily to plug cash flow gaps. If you're having trouble making payroll, you are in need of emergency financing, things aren't going too well, and you're just trying to plug a hole real quick. But recently they've been tried to be used for expansion opportunities, and how quickly these loans need to be paid back and the fact that they're paid back daily make it very difficult for a business to take on this product and see an ROI on the debt capital that they take on. So seeing that barbell in action, we decided that we needed to fill that middle gap, right? So the banks, they have low cost of capital, a good product that makes sense for a business to invest in their business, but it's incredibly inaccessible and the process is very difficult. So we wanted to create a better process and a product that made sense for the small business market, right? And then most of them needed access. So we had to create an underwriting process that made us feel comfortable with the small balance commercial loan market so we could serve the market effectively. So across the board, we're offering a better process, a better product, and in the middle, just access to all businesses deserving of that capital. So what do? We are a small balance commercial lender offering $50,000 to $500,000 term loans in a very unique and differentiated manner. We're offering a 2-, 3-, and 4-year fixed rate installment loan with payments twice a month that allow a business to invest in their business over many years and thus have a payment structure that makes sense for them where they're comfortable paying that back in the time period allotted, so they can actually see a return on that investment prior to the money being due. So what we've found is that a lot of these businesses out there have been putting off projects because they haven't been able to access capital, right? So there's a huge up demand from businesses looking to take on debt capital to invest in their businesses, but until now there hasn't been a way to access that in an efficient manner. So like I was explaining a little bit before, we developed a technology system and put together a team that specializes exclusively on this market. So we're able to collect and evaluate data in real time and offline look at that data, understand it, and make intelligent decisions that allow us to build a book that is very stable, but also allow us to serve many businesses who typically were not able to be served by the other products that were in the market. Or if they were taking on the products in the high interest short-term market, we're able to give them a more efficient product that allows them to invest in their business over a longer period of time and actually see a return on that investment. So another thing about us is that we're not a middleman. There are a number of businesses that are coming to play in recent years that are marketplaces, if you will, where they source loans and then they sell them off to their investors. Well, we are a direct lender. We partnered with Garrison Investment Group back in November to allow us to have the money that we needed to serve this market in a very scalable way. And we hold these loans to maturity, and we service them to maturity. And we do everything we can to make sure that our capital is safe, but also that our borrowers are taken care of throughout the life of their loan and their experience with Fundation. So the characteristics of our product are that we offer the 2, 3, and 4-year term options with rates that range from $7.99, which is a slight premium to what a bank would charge, up to $24.99, which is a little bit on the higher end, but allows us to serve a more subprime type customer without feeling like we're taking too much risk that's going to get us in trouble. So for the bank quality customers, you can come to us and expect a slight premium for the process that we offer. But for the majority of customers, they're going to be able to experience a rate that is manageable and a payment structure that makes sense for them. So what we typically do when customers apply for a loan through us is that we offer them at least 2 or 3 options, a 2-year option, a 3-year option, sometimes a 4-year option, so they can choose the payment structure and the rate that they're comfortable with. Because we can do all the analysis in the world that we want to see what their debt service coverage is and how comfortable they're going to be servicing the debt. But it's really up to the business to decide what they're really comfortable with. So if we get comfortable with it, we hope the business can pick which one makes sense for them. We do take payments twice a month, and everything we do is done through ACH processing. Our security on loans is we're secured by a personal guarantee on every single loan. If a business is taking out the loan to buy a piece of equipment, then we will file a PINSY against that piece of equipment. But for all other loans, we file a UCC1, which is a blanket lien against the business. Another important characteristic about our product is that we do not have any prepayment penalties. So if a business is able to take our capital, invest it, and it results in immediate growth for the business, we're not going to penalize them if they pay down that principal. I think a lot of lenders do that, and the structure of these other products in the market is that they're structured as payment contracts, meaning if they're lending you $1, you owe them $1.20 back, and no matter when you pay it back, you still owe them $1.20. We're very different, and we offer a true loan product where you're only paying interest on the outstanding principal you have with us, and there's no penalty to pay that down. The minimum eligibility requirements, and this is pertinent to you as accountants and your customer base, is we don't do very small businesses at this point, so businesses that are generating revenues under $250,000 we do not do, so all of the businesses in our book have revenues over $250,000. The average size of the business in our portfolio is a little bit over $1 million in annual sales. All businesses have been in business for over 2 years. They all have three employees, and we don't allow any one-person shops or any home-based businesses because we want to make sure that there's a substantive business there that that's going to stay around, and there's other people who are relying on this business being in place. So this product was specifically designed to fill that barbell effect that we discussed earlier, where the banks weren't able to play, and then the other guys we're offering a really unattractive product. So we think that we're serving all parts of the market with this product. So what do we lend for? And as accountants, I think it's very important to realize where the role that you play in the small business's life. And I'll get into it a little bit later, but what we found after talking to thousands of business customers across the country the last few years is the fact that you guys are the #1 trusted advisor of these businesses. And when it comes to understanding their financials and understanding different things they should invest in, they will turn to you, as you probably have experienced, for that advice. And what we feel is that a business needs to invest in their business over the course of their life in order to stay relevant. So sometimes that means expansion opportunities when they're opening up new locations if their industry is growing, adding new business lines, adding new products and services, or simply just hiring to satisfy increased demands. In terms of capital improvements and renovations, this is something that we see a ton coming from borrowers that come to our platform, where a lot of businesses need to just stay relevant, where their building kind of deteriorates or their products no longer make sense, their furniture's looking old and uncomfortable, and they need to make an improvement. And we think that every about 5 to 7 years, a business should be making some improvements to their business, and I think that the cost of not doing something sometimes far exceeds the cost of our capital or any other debt product that exists. So in terms of prompting businesses to do something to make improvements in their business, I think that's a very important factor in the relationship we have with these businesses. We do a lot of equipment and inventory purchases. A lot of businesses have high turn or have rely on certain pieces of equipment to make their business run steadily, and we think that our product is a nice fit for those types of purchases as well. We do a ton of debt refinancing, whether it's family and friends debt, when they want to get that debt off their books and feel more comfortable paying back a lender directly rather than having the burden of feeling that they have to pay back a family member. And we do a ton of debt refinancing on the short-term daily amortization products that we've been discussing. A lot of the time, we will be amortizing that over 2 years versus the 6-month products that most businesses have at that time, making them, giving them a payment that makes a lot more sense and much more manageable, and it frees up a lot of cash for them to work with. We fund marketing campaigns often, and sometimes we fund working capital where a lot of businesses just want to have that comfort of having cash in their account at the beginning of each month, and having a term loan with us is a good way of doing that. We stay away from all startup funding, and we also don't do any emergency financing or disaster relief financing. So if something were to happen to the business, unless there's another location or another business we can lend against, we're typically not going to come in there in an emergency situation. And any cash flow related problems where there's NSFs on the bank account or they're having trouble making payroll, I mean, we're not going to go in there with that because we really don't think that we're going to improve the situation at that point. We only want to make investments in businesses who are going to be using our capital for what we call productive purposes. So if they're going to be bettering their business by taking on capital from Fundation, then we're all for it. So how does this all work? Our underwriting process took us years to create because of the technology that we built. We built a technology that's able to collect thousands of data points in real time, looking at everything from the industry risk of a given business, the risk of a business owner, the risk of the business itself. We do quasi-cash flow analysis through our technology to figure out that service capacity, and it essentially streamlines the process for a business owner where they can apply within 10 minutes by going to Fundation.com or having someone like yourself fill out an application for them through a portal that I'll discuss in a second. And it takes a little bit more than 10 minutes, just under 10 minutes to finish, and that allows us to collect all the information that we need, evaluate that information in real time, and come to a decision as to whether or not we like it. If so, what deals are we comfortable with? And it puts all that data into an easily read format for our manual underwriters who specialize in the small balance commercial loan market to look at and come to a decision. So after the technology does its thing, our customer engagement staff will get in contact with your customer and you within 24 hours of submitting an application to schedule a time for them to talk to our underwriters or collect some additional information where there may be holes in the data. After that conversation with our underwriters, we typically make a decision within 12 to 24 hours, and we present that deal to the customer. So if you compare that process to what a bank typically does, we're essentially condensing a 2 to 3 month process into a 10-minute online application with funding in 2 to 5 days, and with limited to no paperwork whatsoever. Well, if anyone has ever dealt with a bank in terms of their paperwork requirements and how long it takes for them to get back to you, I think this is an enormous difference and an enormous value add to having your arsenal for businesses who are looking to invest in their business and don't want to go the bank route based on a variety of factors that we discussed. So how can you serve your customers through Fundation while you're all here? Like I said before, our goal is to empower our accounting firms that we partner with and part-time CFOs and other business advisors by providing them with alternative access to capital for their client base, by giving them a tool to have where a business is looking for a viable financing option or wants to execute on a project, and you can be the resource they turn to offer them the capital they need to make sure they get that done. As I said before, we have talked to thousands of small businesses over the course of this last couple of years, and the one thing that keeps sticking out is how much they trust their accountants. This makes conversations around capital and their financial situation very common and comfortable. So while they may not be discussing their capital situation with their wife or husband in terms of how their business is going, they will talk to you about it often. And it's important for you to have different options available to them, whether it's Fundation or it's other options that you're able to present them with to allow them to continue to operate their business at a very high level. So when you work with Fundation and you decide to partner with us, as I hope you all will, we'll provide you with access to our partner portal. What this is a portal that you'll be given access to that allows you to submit deals alongside or on behalf of your customers to get preliminary approvals right away, get decisions right away, and allows you to track all the different customers that you put through our system. It provides you with the ability to keep the relationship intimate with your customer and making a seamless transition to working with us. In that process, you'll submit that application. You'll get contacted by one of our customer engagement reps right away within 24 hours, and typically we'll fund your clients that we approve within 40 to 72 hours of them applying. One thing that we promise is that we'll keep you informed throughout the underwriting process and make sure that you're aware of all communication we have with your customers if you request it. Some partners that we work with like to hand off their customers to us completely and want to stay out of the process. And others like to be very hands-on and want to understand exactly what we're looking at and the decisions that we're coming to. and we're happy to do either of whichever one you're most comfortable with. And we are very committed to creating long-term relationships with our partners, and I'd be happy to provide a reference to many of our other accounting partners if any of you like to understand what it's like to work with Fundation. So this is what your portal would look like if you were to sign on with Fundation. It shows you all the deals that you have put in, the ones that are incomplete, funded, under review, that have been rejected, or that your customers have declined. And by just clicking the button, launching the application, you'll be taken to a single sheet that will allow you to type in all the information that we're requiring to submit an application. And this amount of information is typically no more information than is required when you're applying for a business credit card. So the most sensitive information that we're going to request is a social security number, income, net worth, things of that nature relating to the business owner. We also typically collect 3 months worth of bank statements from clients. And for larger deals and some of the more high-risk deals, we will collect financials and tax returns if they're available. So this is what you'll be living in if you ever get access to our portal, and it makes it very easy to manage your customer history with Fundation and submit deals on behalf of your clients. So we are very industry-focused in terms of the types of businesses we'd like to lend to, and it's probably my understanding that a lot of you have a number of these types of businesses within your book of customers. We like to lend to what we consider prime borrowers in skilled professions that have proven to show resilience through recessions and whatnot. Businesses that really aren't going anywhere. There's a huge need for them, and they've been able to weather storms in the past, and we think that given what we're able to collect on the underwriting process, these are the businesses that we feel most comfortable with lending to. However, our underwriting system is industry agnostic, where we understand the risk factors involved with nearly every industry in the small business economy, well over 1,100 of them. So no matter what kind of customer you have, we built our underwriting model to take into account the various risk factors in each industry and every business. So we're not adopting this very strict one-size-fits-all credit box. We're able to understand the various factors and the various things business owners go through from the industry and micro basis to come to a decision that makes sense for us and makes sense for them. So some of the businesses that actually have come our way through accountants are very interesting cases where we had one auto repair shop in Florida who had been trying to access capital from his bank for over 3 months to have the ability to invest in his business and service different types of vehicles. He was only focusing on one type of German car at the time, and he wanted to add a few more types of vehicles that he saw being driven around in his area. This is very common in the auto repair industry recently, where a lot of businesses are taking advantage of the Right to Repair Act, where they're able to get the technology and the parts available from other typically higher-end vehicles that are taken care of or historically taken care of by dealerships and whatnot. But he was trying to take about $150,000 out to invest in this technology and invest in a marketing campaign to tell his town that he had the ability to service these cars now. And he came to us, and he was preliminary approved in 10 minutes, and he had $150,000 in his account in 2 days of coming to us. It was a great example of us being able to fill that void where the bank couldn't help and wasn't able to help in an effective or efficient manner. The next customer is an interesting one as well. This is a neurosurgeon from Oregon who was looking to grow his practice. He was a relatively young guy to start his practice, was doing very well, was doing fantastic, and he was looking to grow and take advantage of the opportunity he had in his market. He was unable to access capital from the bank, and he was looking to hire a new doctor, a new nurse practitioner, and furnish a new office space to adhere to the growth. But what made it difficult was the bank currently had given him a loan under an SBA guarantee to open his business. And many banks aren't comfortable coming in a junior position to a bank loan, another bank's loan, because they want to be senior secured. They want to make sure if something happens to the business, the likelihood of collection is very high. So we're different. We underwrite based on probability of default. So we're okay coming in junior to the banks because we don't think that if something were to happen, there's going to be much to collect anyway. So it makes us very comfortable coming in at a secondary position. So we filed a junior lien position, and we were able to give him $300,000 over the course of 4 years in a very efficient manner. So that's what Fundation's about. We're hoping that we are able to partner with all of you and be able to help your customers out, all those that are looking to invest in their business. And to that end, if there's any questions, I'd be happy to answer them.
As I'm looking through the queue, there's a few questions that have popped up. Here's one. I have a few clients that have loans with banks. I think there's an opportunity to introduce Fundation to them. Do you have any advice on how to approach my clients with this concept?
Definitely. So just like the neurosurgeon I just described, we were very comfortable coming in junior to existing bank facilities. So if they're looking to invest in their business again, a lot of businesses took out a loan from the bank when they got started, and those amortizations can be very long. They can come to us and be aware that we're going to be looking at their debt schedule, and we're going to make sure that we understand the payments they have to make on the existing debt, and make sure that they have the debt service capacity to take on additional debt. That's what's most important to us when we're underwriting these types of deals, right? If we feel that they have the free cash flow to service the debt, we're happy to come in junior. If we feel that the payment's going to be very tight for them, it's typically something we're going to stay away from, and we're going to advise the business owner to pay down as much as they can before coming back to us.
Here's another question. Does your company care where the client is located? Do you issue loans outside the U.S.? And if not, will you consider it in the future?
We lend nationally. The only states we do not lend in are Vermont, South Dakota, North Dakota. Currently, we are not an international lender, but who's to say that that won't change in the future? But for right now, we're focused on servicing U.S.-based businesses. Okay.
We also have a question from another person asking, what about early stage companies that may not have a track record? Do you rely solely on financial metrics, or is it possible that their growth story and their vision may allow them to obtain a loan through your platform?
So younger businesses are typically more difficult to underwrite through a data-driven approach that we employ, because we're relying on collecting the data that's out there from third parties to figure out the viability of a given business and a business owner. So if they've been in business for less than 2 years, it makes it difficult for us to come to an automated decision. But not to say that there are certain cases where maybe they're opening up a new business and they have an existing business, but they're opening up a new corporation in a different business line. Sometimes we'll look at the performance of the existing business and lend against that to give them the capital to open up a new location or a new business. So there are one-off situations that we take a look at, but for the most part, we do require a minimum tenure of 2 years with some level of track record.
There don't appear to be any more questions in the queue, so that wraps up today's session. We want to thank you for attending today's webinar on small business lending, and feel free to reach out to Doug Gordon at the contact information detailed on the screen if you're interested in joining their partner program, becoming a client, or have any questions or comments. We look forward to sharing more helpful webinars starting next month.